we'll talk a little bit about real estate lending. Maybe you can touch upon what has changed in the real estate lending landscape and what has remained the same in today's market.
Real estate credit does have resilient returns even in market correction, market downturns. So those are the things that haven't changed. So what has changed? Well, what really has changed is the entry conditions. I don't think we've experienced starting conditions for new investing as attractive as they are today.
What do you like in the equity markets today?
Yeah, well, it's a unique point in time in real estate market. Like the values have come off by 20, 40%. What this has meant is that the yields have increased by 100, 200 basis points, sometimes even more for some of the best assets, which makes income-driven strategies a lot more attractive. But it's not just any income. Ultimately, when you're looking for income-driven strategies, you care about quality and durability of the underlying income. And what we like in this context are strategies that have infrastructure-like characteristics or that are underpinned by high-quality tenants, covenants, and that have some mission criticality around them.
So, I think in years past, a lot of managers maybe played the set it and forget it game where the market was working so well, it was beta driven. This idea of active asset management wasn't necessarily as important as it is today. So Matt, maybe I'll get your perspective on that.
Yeah, I mean, levered beta, I think in other words, can just be described as luck. In a low interest rate environment like we've experienced over the past 10 plus years, cap rate compression just driven by low debt costs really drove well above average expected returns. In that environment, sort of almost anybody that could buy real estate could win. Where we find ourselves today is in a lower growth environment, higher for longer interest rates, where cap rate compression is a lot less likely. This is where, as Carol mentioned, the asset management, the operational expertise really do come into play because we can get our returns back up to equity-like standards with modest rental growth or NOI growth through operational improvements, either on the revenue or expense side, through slight improvements. A lot of assets today are starved for capital. It's been 2 to 3 years since the real estate market has bottomed. And then with that growth in income, you can see sort of a more reasonable level of cap rate compression. But the differentiating factor is that type of investment takes skill. You have to beat the market. If you stay where the market is, it's very unlikely that equity will achieve returns higher than debt.